Good morning, dear students. Hope you all are studying hard at home and enjoying the e-learning initiative of Cambridge International School, Dasuya. I'm your accountancy teacher, Mr. Sunil Kumar. Today, we will learn one more topic of the chapter. But before begin with the topic, let's recapitulate what we have done in our previous lesson. Before starting the question, we have to recap the rules for debit and credit by both the approaches, that is traditional approach and modern approach. First, we will take traditional approach. According to the traditional approach, accounts are divided into personal account and impersonal account. In personal account, we will take a natural person, artificial person, a representative person. In natural person, these are the persons which is created by God. These are like Aman, Raman, Radha, Mukesh, etc. Artificial person. Artificial person means person which is created by law, and it can be any business. It's a small business or a large business. For example, Tata Industries, Reliance Industries, Punjab National Bank, State Bank of India, Cambridge International School, Chandigarh University, etc. are artificial persons. The representative persons, these are the persons which represents a group of person like outstanding expenses, accrued income, income received in advance, etc. Now, impersonal account, it covers two accounts, that is real account and nominal account. In real account, all the assets will be taken like tangible assets, intangible assets, fixed assets, current assets, etc. And nominal account, in nominal account we will take all expenses and losses, incomes and gains. This is the traditional approach. Rules for debit and credit by traditional approach are here below. Number 1, personal account. It covers all the persons, natural person, artificial person, and representative person. Rule for the personal account is debit the receiver, credit the giver. Second is a real account. It covers all the assets, whether it's intangible assets, tangible assets, current assets, or fixed assets. Few of the example of assets are land, building, cash, etc. The rule for the real account is debit what comes in, credit what goes out. Number 3, nominal account. Nominal account covers all expenses, losses, incomes and gains. And the rule for the nominal account is debit all expenses and losses, credit all incomes and gains. Accounts covered under modern approach. Number 1, assets. Number 2, liabilities. Number 3, capital. Number 4, revenue. Number 5, expenses. Here are the rules for debit and credit by modern approach. Modern approach covers 5 heads. These are assets, liabilities, capital, revenue, and expenses. According to the modern approach, accounts are debit or credit when they are increased or decreased. So let's see all the accounts, when they increase or decrease, what effect they put on journal entries. Number one is assets. When assets are increased, it will be debited. When assets are decreased, it will be credited. Number two, liabilities. Increase in the value of liabilities, credit. Decrease in the value of liabilities, debit. Number three, capital. Increase in the value of capital, credit. Decrease in the value of capital, debit. Number four, revenue. Revenue is also known as income. Increase in the amount of revenue, credit. Decrease in the amount of revenue, debit. Number five, expenses. Increase in the amount of expenses, debit. Decrease in the amount of expenses, credit. So this is the modern approach and the rules for debit and credit by modern approach. Today, we will solve one of the question from textbook Double Entry Bookkeeping Financial Accounting written by E.S. Grewal. For this question, we will practice what we have learned in our previous classes. Let's solve one of the question. The question is, journalize the following transaction. 2019, January 1st, Ram commenced business with cash rupees 30,000. January 2, paid into bank rupees 21,000. January 3, purchased goods rupees 1,500. January 7, drew cash from bank for office use rupees 3,000. January 10, goods sold to Hari on credit rupees 1,000. January 15, purchase goods from Sham rupees 1,500. January 20, cash sales rupees 3,000. January 25th, paid to Sham rupees 1,475. Discount received rupees 25. January 30, paid rent rupees 500. January 31, paid salaries rupees 1,000. January 31, goods cost rupees 200. Sale price rupees 250. Taken by proprietor for his personal use. This is question which we have taken from the book T.S. Grewal, and it is question number 3 in the book. Let's solve this question. Now we are solving the question. This is in the books of Ram journal. First, we have to draw the format of the journal. Date, particulars, ledger folio, debit, rupees, credit, rupees. We are writing rupees because we are in India, so Indian currency is rupee. First, journal entry needs to be passed. On 1st January, Ram commenced business with cash. So, journal entry will be cash account debit to capital account. Debit amount rupees 30,000, credit amount rupees 30,000. Now the rule applied is increase in assets debit, that cash is an asset, so increase in assets debit to capital account, that increase in capital is credit. So According to the modern rule, we passed our journal entry. Narration is being business commenced with cash. A modern rule is quite easy one, and we can easily apply modern rule, and there is increase. We have to just see the increase or decrease. That is why the modern rule is quite easy. If students will follow modern rule, but they can easily pass journal entries. But it is completely the student's discretion what approach they are going to apply, whether they are going to apply traditional approach or modern approach. On January 2nd, paid into bank. Now, paid into bank means we have paid cash into the bank. Journal entry here is bank account debit to cash account. Amount is 21,000 debited and 21,000 is credited. Now, bank, according to the modern approach, is an asset. So, increase in asset, debit, cash is also an asset, decrease in cash is credited. So, bank account debit to cash account. Narration is being cash paid into bank. January 3, purchased goods. When it is written purchased goods, it means it's a cash transaction. We have already seen in our previous classes that the cases of cash transaction, how we have to identify cash transaction and credit transaction. Now, in the question, it is written goods, purchased goods only. It means when there is not any name written over there and no cash is written over there, it means it's a cash transaction. The journal entry is purchases account debit to cash account. Amount is 1500 is debited, 1500 is credited. Now, let's apply the rule, modern rule. Purchases is an expense. So increase in expense is debit to cash. Cash is an asset. According to the modern rule, decrease in assets is credited. So cash is credited. Now the narration is being goods purchased. Whatever is written in the question, you have to write the same in the narration. But it should be started with being and make it second form of the verb, being goods purchased. Now next transaction happened on the 7th of January, that is drew cash from bank for office use. Now see, business has drawn cash from the bank for office use. It means cash is coming in the business and bank account is decreasing. So cash and bank both are assets according to the modern approach. So increase in cash, that is asset, is debited, and decrease in bank, which is also an asset, is credited. So the journal entry is cash account debit, which is increasing, to bank account, which is decreasing. So the amount is 3,000, 3,000. Narration is being cash withdrew from bank for office use. Next, January 10, sold goods to Hari on credit. So the journal entry is Hari's account debit to sales account. Now, according to the modern approach, Hari is a person who bought goods from us and has not paid money on the same day. So Hari will pay us cash in future. That is why Hari is an asset for the firm. Assets mean anything which gives benefit in the future, that is known as asset. So Hari is going to give us benefit in future. That is why Hari is an asset. And if it is a person, then it is called debtors. So Hari is our debtor. Debtor is our assets. So increase in assets is debited with rupees 1,000 2. Sales. Sales is revenue. Revenue's rule is increase in revenue is credited with rupees 1000. The narration is being goods sold to Hari on credit. Next is January 15. Purchase goods from Sham. Now, goods, these are goods purchased from Sham. Now, we have to identify first, is this transaction a credit transaction or a cash transaction? To identify this, we have to see two words in the question. Whether the name is given, yes, here the name is given Sham. Second is there any word cash is written in the transaction? No, the cash word is not used in the transaction. It means this transaction is a credit transaction. Now, purchase goods from Sham is a credit transaction. So the journal entry is purchases. Purchases mean expenses. So purchases account debit. If expenses increase in expense is debited. Here the purchases are increasing. So purchases account is debited to Sham. Sham's account. Sham is a creditor. It means it's a person to whom we are going to pay in future. We have not paid Sham on the same day. That is why Sham is a liability of the business. So what is a liability? Liability means any amount which we have to pay in future is a liability for the business. Here we have purchased goods from Sham on credit, so we are going to pay to Sham in the future. Sham is a creditor for the firm. Creditors means liabilities. So the rule is increase in liability is credit. So the journal entry will be purchases account debit to Sham's account. Amount is 1500. Narration is being goods purchased from Sham on credit. January 20. Cash sales. So when we make sales creates revenue for the firm. Here it is a cash sales, so cash is coming in the business, cash is increasing. So cash is an asset. Increase in asset is debited. The cash account is debited with 3000 to sales. Sales is revenue for the business. So increase in sales is credited. Cash account debit to sales account 3000. Narration is being goods sold for cash. January 25th. Paid to Sham rupees 1475. Discount receipt 25. Now, if you see on January 15th, we purchase goods from Sham and we have to pay amount 1500. But on January 25th, when we paid to Sham, we paid only 1475. 25 rupees is discount received. This is our income. So the journal entry we will make Sham's account debit. Now here we are, here the rule applied is decrease in creditors, decrease in liability is debited. Sham to whom we have to pay 1500, so we are writing 1500 to cash. Decrease in assets. The rule applied here is decrease in assets and cash is an asset. So what amount we are paying? 1475 rupees we paid to Sham. Now to discount received. Discount received is our income. So here the revenues rule will apply. Increase in revenue, that is credited rupees 25. If we will add 1475 plus 25, it will be equals to 1500. So if we see January 15th amount which needs to be paid to Sham, that is 1500. We have written 1500 on the debit side in front of Sham, that is 1500. And on credit sides, we have written cash account 1475 to discount received 25. If we will add 1475 and 25, it will be equals to 1500. So the double entry uh, rules is also applied, that debit is always equals to credit. So 15, both the total of January 25th is 1500 and 1500. Narration is being cash paid to Sham and received cash discount from him. January 30, paid rent. So the journal entry is rent to cash. Now, rent here is an expense. So increase in expense is debit. So rent account debit with 500 to cash. We are paying rent. Rent is paid through cash. So decrease in assets. Cash is an asset. So decrease in assets credit 500. Being the narration is being rent paid. January 31st, paid salaries. Salaries are also an expense for the business. So increase in expense is debited. So salaries account debit with rupees 1000 to cash. So salaries are paid through cash. So cash is decreasing. Cash is an asset. So decrease in assets is credit. So to cash account. So the journal entry is salaries account debit 1000 to cash account 1000. The narration is being salaries paid. Now again on January 31st, goods whose cost is rupees 200, selling price is 250, taken by the proprietor for his personal use. Proprietor means the owner of the business. When he takes the goods for his personal use, it means he will always take goods on cost price, not on sale price. That is why here in the question, when two amounts are given, cost amount and sales amount, and if the goods are taken by the proprietor, always cost amount will be taken. So the journal entry is decrease in capital. Drawing is also known as capital. So decrease in capital, that is drawings account debit. The rule applied here is for capital. So decrease in capital debit, drawings account debit. 2, purchases. Purchases mean goods. Goods are decreasing. So decreasing goods, that is expenses decreasing, decrease in expense, credited to purchases account. Whenever the owner or the proprietor of the business takes goods for his personal use, purchases are always credited. So the journal entry here is drawings account debit to purchases account. Amount is 200, which is cost price. We will not take selling price. Only cost price will be taken when goods are taken for personal use by the owner. Narration here is being goods taken by Ram. Ram is the owner of the business for his personal use. You can write goods being taken by the proprietor or owner for his personal use. This finishes our question number 1. This is question number 3 of T.S. Grewal's book. I request to all the students, please practice more and more questions at home. And if you feel any problem in any question while passing journal entries, do let us know so that we can solve your query as soon as possible. So this is all for the day. Thank you for listening it very patiently. Till then, stay safe, stay healthy, and stay at home. Thank you.